I'd like now to open questions and answer session. So, Sean, please, can you join? And we have 2 mics here, and I will pass, yes.
Yes, thanks, Axel Michaelova from University of Zurich and Perspectives. Thanks for the nice presentations. I would have a question to Sean regarding the climate bonds. In my view, any green bond will only lead to, let's say, a change from business as usual if the interest rate structure is different from, let's say, plain vanilla bonds. And you mentioned this Chinese regulation which could lead to such an outcome. So what other kinds of regulatory instruments would you see that would then really make this an instrument that reduces the financing costs for specific mitigation activities?
Well, actually, you're wrong. Investors are keen to green their portfolios within the regulatory constraints that we've given them in terms of how we manage insurance funds and pension funds. They want to be able to swap out their AAA green bonds, AAA non-green bonds for AAA green bonds at the same interest rate. And that's what's driven this market. And there's a very strong demand for that. That's the first thing to say. So what that has allowed is an opportunity for people to bring green projects forward. It's given AAA rated institutions, and by that I mean every rated institution, an excuse to go hunting for green assets, their portfolios, because they'll get access to investors that they're not currently in their book. It's called investor diversification. And that's what's driven this market. Every treasurer in the world wants to have more investors. They know they can eke a little bit of price over time out of more investors. That's point one. Having said that, yes, if we can get price benefit, then that's an extra bonus. Now, bond markets, when you create a bond market in Korea, in Japan in the 1950s and so on, they always start off flat priced to loan market. It's only once the instrument gets established and investment funds appreciate the liquidity that you get price differential. So you now, in established bond markets, raise money at a cheaper rate in the bond market than loan market. This is exactly what is happening in liquid green bond markets in Europe and USD. So in Europe now, you will find issuers saying they're getting price benefit of about between 2 and 15 basis points, which is exactly what you're saying. Now, they're doing it because in the secondary market, people love green bonds. There's not enough of them around. Investors like Benito hang on to them and don't sell them. And so as a result, they're scarce. And as a result, they're a premium product. This is such a strong driver now that we have bonds who come to market, their order books being dominated by hedge funds, who are buying bonds to flip onto the secondary market because there's a price differential. So you've got a market dynamic based on the extra features that are green in these bonds, which is delivering lower price benefit. And that's what's going. But to complete what we can do, to increase the price differential, there are further things we can do. So what the Chinese are doing around liquidity lending is an example. We have had Vice President Jablunovskij here say in the European Commission that they want to bring in risk weighting differential for green mortgage bonds and green vehicle bonds. I believe that will happen in the coming year, thanks to a Bank of England study, which shows that there is actually a valuation difference between green mortgages and non-green mortgages. So they've got now quantitative, a Washington consensus academic argument to allow this differential now, and so on. And there are many more things we could do along these lines. So when I'm saying you're wrong, your premise about investors moving is what I mean. You're wrong there. Investors will move a flat pricing. But of course, we can turbocharge a bit of pricing over time. And this is what we're beginning to see. I appreciate in Australia, this is called a Dorothy Dixer question. He knew the answer. But I thank you for asking the question of me.
Thank you.
Sean, investors like me are bankrupt.
I'm so sorry to hear that, Benito.
But the point, I have 2 questions, one for you and one for Julianne. The one for you is actually in the context of the narrow topic of the seminar, is the use or not use of green bonds to raise capital for the multilateral funds, and in particular the financial mechanism. And how do you see the viability of this idea. Could it be done? Would it be viable for the GCF? And then, wait a minute, I wanted to give the question. Yeah. The question for Julianne is, I'm intrigued. I mean, many of the features are similar to the one which we proposed in terms of differentiation, all that sort of thing. Who would collect this, right? Under what jurisdiction would that happen? Because even airline tickets are difficult. I mean, the reason why we had it in the CDM was that the governments in the issuance of CERs, which was the currency, or is the currency, governments have no role to play. It is between the CDM executive board and ultimately in the end the adaptation fund. So the government's treasuries have nothing to say in there. The moment treasuries get involved, the problem is they see it as their money. It becomes very much not an international tax anymore, it's our tax, and then it becomes tricky. So I would like to know how you solve this issue. Thank you.
I'll start off in that case. Yes, of course. There's a lot of scope for institutions to issue bonds. That's what banks do. We're not leveraging, we're allowing this ridiculously high leverage ratios with private banks, and yet we're hardly getting any leverage ratio with a bunch of institutions that are around that are public sector, which are frankly safer than the commercial banks, like the Green Climate Fund. The Green Climate Fund could be issuing green bonds against its current portfolio, using its own current lending rules with no dilution of anything, raising money on the back of the nature of the support and the loans that can borrow. You've got a question who wants to follow up in the back there in a minute, but shall I finish off and give it? Go ahead. So that applies also to all the other underutilised funds that are around. Now, some banks like EIB and World Bank and so on are already using bonds to effectively raise money. They could be doing more too, because in a lot of cases they could be putting some of their loan portfolios into a special purpose vehicle and refinancing those off balance sheet to get more money for their main balance sheet lending. In other words, they could increase their overall lending capacity by using structured finance. There's a lot they could, like I said before, this is not playing with empty homes in Las Vegas, which led to the crisis of 2008. This is playing with blue chip loans, usually with government backing on it and so on. So we could actually get a much more significant leverage ratio with just basically zip all impact on financial markets from what we're doing now. The last thing that we could do, which is being blocked by 4 countries at the moment, is change our accounting rules around guarantees. So if Germany wanted to provide a guarantee to the Green Climate Fund to issue a bond under its own terms, at the moment it has to book the full value of that guarantee on its balance sheet here. Put that against our capital ratio rules for banks over here, which allow a 10 times or 12 times leverage ratio. Why is there a difference? Because essentially a guarantee is a type of insurance instrument. Now, if you were using the banking system leverage ratios, you'd be allowing Germany to book 8% the value of that guarantee. In other words, they could do 12 times as many guarantees for the same impact on the national balance sheet, which is perfectly normal, except it's being blocked for history. OECD sets the guidelines. 4 countries, Japan, Germany, the UK, and the USA, are blocking changes in the global accounting rules. With one stroke to accounting rules, we could multiply potentially the rich country's support to drive down interest rates in emerging markets by 12-fold, like that. And that support could be allocated to refinancing by multilateral institutions who could then increase the amount of loans they can give. This is still loans, this is not grant money. So I'm not trying to replace the grant money that we cover by you. This is extra because the bulk of what we have to do to green the cities of the world over the next 30 years, which is where 80% of capital has to go. There'll be 20%, which is not going to work this way, but 80% can easily be done with loan funding as long as the rates are low. So that's an incredible opportunity for us. And it can all be done, yes, through multilateral institutions. Heinrich Boll Institute's a bit nervous about this, so.
Thank you very much, Sean. I'm Liana Schalatek from the Heinrich Böll Foundation, and whenever the GCF comes up, I pop up, and particularly when somebody calls the Green Climate Fund a bank, which it's not. It's a fund under the UN Framework Convention on Climate Change, And at least the way the political discussions are currently going in the Green Climate Fund, and I don't see any immediate change to that, and in the past there is significant opposition to turning the Green Climate Fund into a bank. So while the Green Climate Fund in several projects has supported bond issuance through accredited entities, for example, there are 1 or 2 projects, I believe, through the Inter-American Development Bank, although that might have been lapsed. But again, the idea was to work with implementing entities in bond issuance. There is currently no mandate, nor from what I can tell from having observed the board for the past 5 years, an appetite to turn the GCF into a bank with the opportunity for its own bond issuance. That doesn't mean that it doesn't change in the future. We had a little bit of a conversation in a break in between. Certainly finance is needed, but again, I think while certain things are feasible, and hopefully in the final panel we can talk about a lot of ideas that are technically feasible and maybe should be done, a lot of it hinges on political feasibility, and at least for the foreseeable future, I don't see any political feasibility for that in the GCF, from my observation. Thanks.
Julian, I don't know, do you want to come back? Okay, one more question, please.
Well, first of all, thank you so much. Very interesting. Both of the presentation, great. I'm Silvia Mancini from the Adaptation Fund. And in fact, this question is not, it's when I used to work for Moody's at one point in my life. So I just want to know what you think about the current rating agency system, how ready it is to develop what you are mentioning. It's very much linked to how this will be rated. And we know that there is, that the 3 big rating agencies may have some different opinion when it comes to emerging markets or when it comes to developing this strategy, which I believe, I am with you when you say this cannot be covered only by public funding. This is one question. The second question is with regard the taxes. I think again, what a great, thank you for a great initiative, absolutely. How can we avoid, the taxes always brings a lot of, raising taxes at some level always has an aspect, has a social aspect to it, and unfortunately, these days we are aware of what's happening as well in terms of raising taxes. So how can this be accepted? How can it be transparent, not only within the climate funding arena, but mainly out to everybody? And okay, thank you.
Let's work where we can work with multilateral institutions. I happen to think the GCF's unwinnable, but hey, what the hell? Let's set up a new one. In the Western world, we set up new ones all the time. In Europe, we've got a thing called Eurofema. That's a government-backed institution backed by multiple countries that funds railways in Europe. It's a special purpose. All it is a bond-raising institution. It's not a bank. It raises bonds in the market and channels them to railway projects in Europe. We can do one in Asia, in ASEAN, let's say, working at the multiple countries. We could do one in Africa focused on small landhold developers. There's lots of options we can do if we've got a distribution mechanism and we've got the adequate credit-worthy deal flow by countries underneath. So there's a lot of things we can do here. I'm not fussed on one particular institution. I'll still stick to my line, GCF could do bonds, 1. 2 is on rating agencies. Well, we're stuck with them, aren't we? I'd love to change it. We had a big debate at the high-level expert group on sustainable finance last year, which I was a member of in Europe, about setting up a national rating agency in Europe. In the end, we thought that was just a government-owned rating agency was probably not going to work either. So the process has been on pushing the rating agencies. The rating agencies in Europe are terrified of having their profits eaten away. I mean, let's be clear. S&P's profit margin in Europe is 40%. Mike Wilkins at SP is a good friend, but there's clearly a monopoly rentier thing going on there. We at least need to push them in a direction to better reflect forward risk. Well, they are responding under threat of being regulated further. So Moody's, in particular, has rolled out a whole series of resilience and adaptation methodologies for rating agencies, which are really worth looking at and they're looking to try and do a lot more in that area. There's work happening there. S&P's doing stuff on the forward risk of climate from a mitigation perspective. So they're doing work in the area. From my perspective, we've got no choice but to work with the existing system because we missed our opportunity in 2008 to totally reform the whole rating agency, and it could be another 10 years before that opportunity arises again. So you work with it. The bigger investors do their own internal ratings anyway, so they don't rely on the rating agency. So that's a sort of complicated answer. I suppose my last response is there's a lot of moving parts in all of this. We're not going to get all these things perfect, not going to get rating agencies perfect, we're not going to get the governance mechanisms of a fund like the Green Climate Fund perfect. We just work with what's in front of us that we can move on. The key thing is there's so much we could be doing right now that we are simply not doing that's right in front of our nose, is what I'm saying. I can find you half a dozen multilateral funds that could be issuing green bonds, even, and leave the GCF aside. We can act. We've got to act. You know, we've got to reread that IPCC report, reread the IEA 1.5 degree report, and just think about every day we're not doing something is an increased threat of species extinction. That's the way we have to think.
Julianne, please.
Okay, thank you. I'm glad to hear you're intrigued, Benito. That's good. We obviously looked at work that you had done in the EAPL proposal and other proposals, and tried to learn from each of them. And that was, to your question about who would collect it, what would the jurisdiction be once treasuries get their hands on money, they think of it as their own and they're allergic to earmarking. And so we learnt from, I referred to earlier, the International Oil Pollution Compensation Fund, the IOPC. So our proposal is very much based on how that works, an improved version of how that works, which essentially is that the IOPC works in that companies that ship oil around the world pay a levy for every barrel of oil they ship, roughly, into an international fund. So the money goes, as you said, with CDM, share proceeds, etc. The money goes directly to the international fund. It does not pass through treasuries. And our proposal is the same. On when fossil fuels are extracted, the company or entity extracting the fossil fuel, the coal, oil, or the gas, would pay the tax directly into the international fund. Countries where fossil fuels are extracted typically already charge royalties, etc. So they already know how much fossil fuels are being extracted in their country. The administrative work is being done. The countries would then submit that information to the International Solidarity Facility run by the GCF, who would check that they've got the right amount of money, issue invoices if they haven't from the entity extracting the fossil fuels, and make sure all the sums add up. At that point, the amount of money that the country deserves for fair transition, so if you're the UK and you're getting 50% of it back, that would then be transmitted back to the country. We need to keep it out of treasuries because they won't give it up. So we designed it that way on purpose. And because we need all those things that Charla was talking about earlier, we need money at scale, we need to know it's coming, we need it to be predictable, we need it to be on top of, crucially, we need to be on top of ODA or aid and climate finance that already exists. So hence, the design helps with that. It's not going through treasuries, it can't replace ODA, it's as well as. And I think that was a really important question that you asked the lady from the Adaptation Fund about tax. I've been talking about this idea for a little while, but the report we will release on Monday and what I talked to you about today has changed somewhat. We've updated our ideas. We've listened to feedback that we've had. Initially, we called it a carbon levy. And we rebadged it as the climate damages tax because we thought that sounded much sexier, much harder. We want to make it clear that the fossil fuel industry is the one causing this damage. They should be the ones to pay for it. At the moment, but particularly the poorest people in the most vulnerable countries, are the ones paying for the profits of the fossil fuel industry. So they're making billions, hundreds of billions of dollars in profits. The rest of us get to pay the real cost. That is clearly not fair, and we need to address that. And so we wanted to make that front and centre of our call. But taxes are still tricky, hey? A lot of people don't like taxes, but there's been work done. So in our new design, we took into account some of the work that had been done. For instance, the Grantham Institute in the UK has done work on how to make green taxes, climate taxes, more acceptable to communities. And we took that work into account in our design. So starting low is one of they have like 4 key things you should do. Starting low is one of them. So we're starting at $5 a tonne of CO2e. Being very transparent where the money is going is another, which is super important to get public buy-in. And so we also hope that this, in our design, it would certainly be designed in a way to make it transparent. It should be fair is really crucial for people to see that it is designed and implemented in a way that is fair. And so, as I talked you through the equity principles that we had incorporated, and the fact that a significant portion of the funds would go to loss and damage for the most vulnerable countries, but also the fair transition element would be aimed at low-income communities. So helping people who currently do not have the capacity to move to fossil-free transport, to move to fossil-free energy, and helping communities that will be very impacted by the shift to a fossil-free economy to find new jobs, to find new, what's the word I'm looking for? Industries. So we incorporated those elements into our design as a way of both acknowledging that, any tax needs community buy-in in order to be implemented. And the fact that in our ideal scenario, we do have other ways you could implement it. Like in our ideal scenario, it would be a global tax, so you can see that it's global and there's fairness elements incorporated into it as well.
Can you again repeat the unveiling of your report is on Monday, yes, and it's an event?
Yes, the unveiling is on Monday at 6:30 p.m. In press room Katowice. Thank you. And but the report will be available on the website from about noon on Monday.
Okay, thank you.